Hi everyone, I'm Rick Bensignor. This week's In the No Trader Daily Tip Sheet Weekly Macro Outlook is being recorded on Sunday afternoon, September 24th, because tomorrow I will not be working. It is the Jewish holy day of Yom Kippur. I will, as I say, not be working tomorrow, but I didn't want you to miss having the weekly macro outlook, so I am recording it now Sunday afternoon. And I will send it to you upon completion here such that there won't be a live webinar tomorrow morning, but you will be able to actually watch this at the regularly scheduled time or anytime you wish, because I will attach the clip to an email to you. So let me go over the things I want to talk about just like I would as if it was Monday morning. What I don't have is the advantage to seeing how futures are going to trade to give us a sense of how things are going to start off the day. But that, so be it, that's the way it is. Here are the major points I want to talk about. Equity indexes broke down last week from the hawkish Fed comments that Fed Chair Powell gave us. They are quickly approaching some key levels for S&P terms. I have long told you about the 42.75 level. So we are getting close to that, and I will be doing some light buying there. Those who follow Elliott wave type counts have gotten very bearish. And there are some major downside targets now of at least 34.08, if not 26.79 to the S&P. So many of them are going into full-scale bearish, not just positioning, but thought process that we will take a look at as we go through the charts. Moving on to fixed income, U.S. 10-year rates closed on the highest Friday close of the entire secular move. They did, however, also mark a TD combo plus 13 signal last week, of course, making it that much more difficult to just simply play for higher rates, which I generally would be, but we've got this counter trend signal, and when we take a look at the charts, the last couple times those have shown up have been pretty good locations in which to fight the idea that rates are going to keep moving higher. The U.S. dollar index is closing in on the 106-ish target that I've had for a few months now. Gold continues to be in that neutral camp. Crude oil got up to about 92.5 or so, a couple bucks shy of my mid-90s price target. But interestingly, to finish off the week, crude oil actually closed lower than the prior week, so that could be a potential near-term kind of stopping point. And nat gas remains absolutely nowhere for now. We will continue to see that it is just sideways now for a few months and nothing much going on there. Let's take a look at the charts here, and there's a lot going on here in this S&P chart. This is the daily chart of the spiders, and then we'll get into the weekly chart. So let me just go through a whole bunch of things that are happening. The breakdown last week broke beneath the bottom of the daily cloud. In fact, Wednesday to Thursday created a gap, so that would be kind of first near-term resistance should we get a bounce. We come into today on a setup 6 count towards a setup 9. The last setup 9 we saw was a day after the peak was made. The one before that was right by the highest of this year. Setup 9 counts often are important too, not just the 13s. On a daily chart here, the bearish propulsion full exhaustion level off of the high from late August, early September comes in at 427.24. That's this level here that I've highlighted in this yellow box. Potential bounce point there. You'll notice in a couple of days that could easily be where the lagging line from the cloud, this dark blue line, which is nothing more than current price pushed back 26 bars, also finds some support right there. It certainly becomes an important level. Beneath that, we have the uptrend line. This bold purple line comes from last October's low. So that's coming from the cyclical bottom of the move. Just beneath there, or depending upon, it could happen, I guess, on Monday or Tuesday, there is an unfilled gap from the last day of May to the first day of June. You can see here, so I've identified a second gap here that could easily come into play. And just beneath that is, if I measure from the high this year, and we got where the bearish propulsion momentum level is, that's the downside. That's the full downside exhaustion level. I don't have the actual price here, but it's somewhere in, I would say, the 422-ish neighborhood, something like that. And beneath that, you've got the 200-day moving average. So lots of things here on the downside. What else? A horizontal green line, which is pretty much the neckline of the head and shoulders pattern. So we had a rounding top in June, higher highs into July. We sell right back down towards that level. We get a bounce into the August or early September high. On a 9 count, we come right back down. There is a head and shoulders here. If it's hard to see with all the stuff on the chart, look at the lagging line. You can see here's a rounding top. Here's the bigger move, and now a second rounding top that has come down and actually closed just beneath the neckline. I'm going to keep this horizontal line green until we see what happens on Monday. If we get a further break, then I have to say that that neckline broke. If we happen to get a surge or some buying tomorrow, anything that closes above that horizontal line, then I'm still going to keep that horizontal line as the neckline. What else do we have here? 443.37, the dark magenta colored line, still the heaviest volumed level in the last 30 days of trading. Second highest level is all the way up there near 450. I doubt that comes into play in the near term. I do think that if we do get a bounce, and we certainly could, you're going to watch for the daily conversion and baselines. They're just right here against the bottom of their cloud, so it's a little hard to see them in here. I've got them listed in the spider trading level, so you'll see where they are as of Friday's close. They will likely move again on Monday, but at least you'll have those levels and you can see them here. So first resistance against the gap, second resistance against the conversion and baselines. And I would think that if this got back up to near 441, 442, somewhere up in that level, you're going to find some very significant resistance. Not only is that where the baseline and conversion line is, it's also where the bottom of the value area, this yellow zoned area, represents 68% of all the volume done in the last month. That's the first standard deviation of price action, and price action should be capped by this magenta line. So any rally right now would still be meant to be sold, and then we can figure out a buy stop against that. And I would love the opportunity, to be able to sell up against that range. That's the daily chart. Let's move now to the weekly chart, just kind of get the bigger picture of what's going on. And we've got the downtrend line from all-time highs from basically the end of December from 2021. Last year, 2022, a down year for 10 of the 12 months until we got the October low. So let me also explain here that why the Elliott wave people are getting quite bearish. They're looking at the all-time high as the peak in price, the beginnings of either an ABC down, so A would be the whole move down, B would be the move up, and if this move has topped where it did, then C measures considerably lower. If so ABC could be one particular wave count. Alternatively, if this all-time high is the start of a bigger down move. And we can actually see that the decline was a 5-wave move down into last October's low. Follow my cursor. 1, 2, 3, up to 4, down to 5. Then that's all part of wave 1 of a much bigger decline coming. This is the ABC correction back up. And if this is a 2 on top, so 1 down, 2 up, then waves 2 to 3, which is wave 3, is the most impulsive and strongest of the waves. So this could be, in the bearish scenario that those people are laying out, this would be the top for a very significant move down, which if we were to do just equal legs down, in other words, from the all-time high to the October low, take that point distance and then subtract that point distance from the high that we made here in July this year, that measures down to 3408 in the S&P. That's lower than last year's low, and it makes sense because we're taking the same distance here off of the high and taking that distance from the interim high. That would measure down to 3408 in S&P 500 terms. And if this is the beginning of wave 3, and wave 3 ends up being 1.618 times the length of wave 1, which many times they are, then you're talking about a move down to 2679. So major, major bear market. So those who are in the bearish camp thinking that this rally was a counter trend rally in what really is a much bigger bear market, then they're looking at the recent peak in July as being the top to wave 2, and then wave 3 goes significantly lower, undercutting last year's lows and possibly even going well further from that. What supports that argument? I can't tell you that that's necessarily going to be, I'm not coming out here in middle September or late September of 2023 and telling you that we are about to fall apart. We do have a negative MACD cross that's starting to pick up some downside momentum. Again, why do I care about 42.75 in S&P terms and it's 426.5-ish or so in SPDR terms? Because that's where the bearish propulsion level is. And if we look back to the last 3, I've got them all circled in bold cyan blue, those were always the bottoms to the move, including the October low, where failed bearish propulsion sell signals, which turned out to be bullish ones. I've said to you before that I generally do what has worked in the past until it doesn't work. So the assumption here I'm going to make is that this level can certainly be tested and potentially hold for a rally, as compared to just playing this as if it breaks there as a break. Now, here's a few things to know. Last week was a down close. That means this week it's not qualified. So if we close underneath S&P 42.75, it's not a qualified break. It doesn't mean it can't keep going, but it's not. This line will stay dashed lines and not turn into triangles. Triangles tell me that all the rules were met for a pure sell signal. The fact that the baseline is virtually the same price this week as where that level is another reason why I think we could potentially get a trading bounce. And it could come, we could sell off Monday, Tuesday, Wednesday, but if we go back to the daily chart, Wednesday could be a setup 9 count because we come into this week, it was bar 6 on Friday's close, so Monday is a 7, Tuesday is an 8, Wednesday is a 9. We could end up getting a decline into support on a setup 9 count, and then we play for a trading bounce that will probably lean into anyway after it rallies. So the weekly chart, given that it took the move, when you think about an S&P here, we can use SPDR terms, from roughly 350 or S&P 500, 3,500, we went all the way up to 4,500. We had a 1,000-point rally But the only time that the DeMark sequential model actually indicated that it could be tired, that the rally is exhausting itself, is on that 9 count. So all the up and down price action here killed whatever live set of counts there were at the time. But we finally got a string of 9 consecutive Fridays that the close was above the close from 4 Fridays prior. And that occurred a week or so before the high was made. So that's the picture that we're looking at for the near term, and why it could still be that this decline is not the beginnings of a massive move lower, but one that still shakes out some recent longs, the late to the game longs, and presents a buying opportunity. But if you're going to be a buyer, and I told you I'm likely going to replace, I think I'll replace, I was going to replace most of it, but I'm not sure I'm going to do that. I may replace half of the S&P, the spiders that I sold earlier this year at 450. I told you when I sold them in real time. Those were sales of spiders I bought last year at, what was it, for the October lows, those were 371s. Yeah, I bought them right in here, right after the low was made. I went long spiders in my IRA account with money that I had raised over the course of the year from when the market had sold off. I had sold out a whole bunch of stock positions. I used that money to buy spiders at 371. I sold them out at 450. And all the mishmash since then, I only put a third of those on, in here just as trend had, we weren't going up, we weren't going down. I didn't want to have no profit from that trade. So I put a third of them back on. I'll put some more on down here, and then I have to decide what I do or where I add more. Notice the TDST level here, this horizontal line is at 409.87. So let's just call that roughly 4,100 in the S&P, and that's another level that if we sell down to, I would probably be interested in putting on some more exposure. But of course, if we get down there, and you can see why there should be support based on these prior highs and the breakout, not a bad place to think about putting some more exposure on for the long term. But, the question will be, is this recent July 2023 high the beginning of a massive down move for all the reasons that the super bears think that all hell is going to break loose? I generally try to avoid the mega bulls and the mega bears thinking because they tend to be very extreme, and it's rare that you get such massive moves like that. So I'm not going to make that call yet, but I will probably be doing some buying around 4,100 or so. Here's the Qs on the daily chart. So peaked on a 9 count, just like S&Ps, except, well, the S&P was the weekly, but even the daily, the high in August, or the very end of August, early September, was a 9 count. So did the Qs right into the bullish propulsion momentum level. Same thing like the S&Ps, they failed against it. Here's the price action since. Price has fallen out from the bottom of the cloud. Again, there's a gap created from Wednesday to Thursday of last week. That's going to be first level resistance. The daily TDST line has been closed beneath 2 days in a row. It's not qualified because, again, down closes preceded it. There is not a, well, actually here, there is kind of, I didn't draw it on the chart, but if you look at, again, the possible head and shoulders, and we use this as the bottom of the left shoulder somewhere, looks like about 357 or so. I drew a horizontal line across it. This day actually closed above it because we opened low and closed high. Here we are kind of sitting right on the neckline again. So whether it's the S&Ps or the Qs, you are virtually on the beginning of a bigger decline. They also come into today on a setup 6, so 7, 8, 9 for over the balance of the first 3 days of this week could give us a 9 count into potential support levels. 350.84 on the downside to 347.56. These two levels are a prior but still active bearish propulsion full exhaustion level off of the highest high in July is the 350.84, and then the more recent breakdown, and you can see here, this was a qualified breakdown. These are downside triangles in let's call it dark brown that got kicked in over here. We've already hit the exhaustion level, and the full exhaustion level is all the way down here at 347.56. So those are near-term bounce points, possibly from Tuesday and Wednesday's price action if we get down there. Here's cues on the weekly chart. And what is interesting here is the bearish propulsion level is at 349 and change. You can see it off here on the right. The uptrend line from, instead of using October's low, because this double bottom tested that low in December, that's really, we're going to take this higher of the two green trend lines here. So that comes in also right about for this week, that 349, 350 level. And the baseline is at 348 and change. So clearly some decent support just beneath the lows we saw this summer. If we break those lows, you're going to trigger some selling. And the question is, how much of that selling will be weak-handed longs getting out versus new buyers taking advantage of that? Or do we break this and then we get a more substantial decline and then we start pulling back to the prior broken downtrend line and we run into potential support from the 50-week moving average, the 200-week moving average, and the propulsion exhaustion level to, if this breaks here at 349.37, then the target down comes to 310.76 or so. So, you know, that becomes your kind of next level of support. So look, the market's got to really deal with, investors have to deal with the fact that the higher for longer scenario that Chairman Powell laid out is really taking a toll on the near-term market outlook and has given late to the game buyers some real pause and potentially selling out of those positions. You know, if you got long early this year, you may not get out until maybe these levels break. But others who got in up here are already feeling the pressure. Look how good the 13 signals were here. Not only, it just got cut off, not only is the all-time high on a combo 13, and then the test of that high was on an aggressive sequential 13. The low was on an aggressive sequential 13. The subsequent high this year was on a weekly 13. And then the interim high made a few weeks ago that I alerted you to was an aggressive sequential 13. Those all came into the target zone, which is in cyan blue here, that I had laid out all the way back late last year, that if this, no, I'm going to take that back. It was probably in the spring when we broke above the propulsion momentum level, and you see the triangles turned, or the dashed line turned into triangles, meaning it was a real breakout. I posted that target then. So I had propulsion targets, which have nothing to do with the timing models of sequential combo, and yet combined, look at how good these are at picking the area where the market exhausted itself on the upside. I kind of think it's pretty incredible that in this case, months in advance, you could predict where the upside target would be, and then when it actually got there, the timing models happen to line up and suggest similar exhaustion of trend. Let's move to the bond market now. Here's the IEF, that's the ETF that tracks the 7 to 10 year bonds. So it's not a perfect inverse image of TNX because it's a 7 to 10 year bond proxy, not a 10-year bond proxy. It finally last week took out the lows from last October, and that's when rates had first gotten up to 4.33% in the 10-year before backing all the way down to 3.25%. It finally took that out. But again, as soon as it does that, you get a 13 signal, the newest 13 signal. There have been some other ones. The first one wasn't anything. Second one was good for a bounce for a few weeks. Last 9 count was good for a week and a half or so on the upside. And now we get another one. So to me, if we spend, the more time we would spend back under 4.33%, last year's yield high, the more chance that you have a potential top in yields. In IEF terms, that's about 92. In fact, it looks like we kind of closed just about on there. So I don't have the precise level, but I see we closed at 92.44, and it looks like the close is just a hair from where that line was. So the more time we would spend back above the line, and especially if we can break the downtrend line here in red, the sharpest of the 2 downtrend lines I've drawn, the better chance you have a top in yields and the chance to buy bonds. Here's the weekly chart of IEF, and it's been tough going. I told you, fixed income traders have had a very difficult time this year because A, it's been very choppy, and B, you've had mixed signals. You've had 13s to deal with, which either didn't work or got you a 2-week rally only to see it sell off again. Now, last week, again, obviously, if we did it on the daily, we did it on the weekly. You broke beneath last October's low, and yet you closed pretty much on that line. You're on a 7 towards a 9. If we continue lower, which means if rates continue higher, we've got a couple of targets down here at 90.59 and then 89.85 are some of the downside targets. Tough as heck. One of my biggest institutional clients is a large fixed income portfolio manager, and it's been chop and a difficult year to trade. And you can see if you just watch something like the weekly chart, we get an up move, it pulls back, up move that takes out the highs, but then we sell off and take out those recent lows, only to turn around, take out the high, and then pull back, and now we've gone all the way back underneath the lows. So trends don't last a heck of a long time here. Sometimes you get a couple months of a trend. Sometimes you don't even get that, and they become, anywhere from 2 to 5, 6-week trends. And so it's short-term trading, but most portfolio managers on the institutional side are not interested in 1-month-long trends. They're looking for the big picture, and this whole year has been chop and a really difficult time for them. TLT, the 20-year bond proxy, and I've told you many times, this actually gets more trading volume than does IEF, even though IEF or the 10-year is really the U.S. benchmark. 20-year bonds are not the benchmark, and yet TLT gets the bulk of the ETF volume in this neighborhood. So we've got a 9 count from a few weeks back. It's pulled back beneath there. You're still within the context of that idea of the 9 count wouldn't get stopped out until somewhere down, probably towards 87.5, 88. The one downside target I've got here is down at 85.80. That is the risk level to that 13 count, and here that's where it says that 13 count would be stopped out from being the signal. So tough as heck. You've got this triangular pattern right near the bottom. And did the one close last Friday mean that this broke, or is this just a fake out? We turn around and go right back up and start again playing with the other side of the triangle. Credit spreads. Probably the thing that I'm having the hardest time getting a grip on is why credit spreads last week narrowed. This pulled down to 1.2%. It had been 1.23% the week before. So why did credit spreads narrow by 3 basis points last week, given what's going on in what Powell said, what the stock market did, what bonds did, and yet credit spreads have narrowed? I can't quite figure that out. I've got a small widening position on. We put my institutional clients, I got them right here at the bottom at 1.19% we put on. And a week ago from Monday of this week, so last Monday, I added to it, so I've got an average long at 1.21%. We closed at 1.20%, and I'll stop out under 119 or 118. Not that necessarily breaks it, but from a pure risk-reward point of view, I don't mind risking a couple ticks for the chance that this could be worth 10 or 15 ticks on the upside. So the upside breach of a tick or two above the downtrend line has pulled back. Nothing really going on here, but the biggest thing is, if there's really expected trouble in the system, why aren't credit spreads widening out? And that may be the clue as to why bond prices may end up rallying from here, and that the perceived stress in the system may not actually be happening because it's not showing up in credit spreads yet. Let's move to the U.S. dollar. I've long had a 105.97 target. In fact, that target I put out the week after the low for the year was made. That low was precisely against the bearish propulsion full exhaustion level. These orange triangles here on the downside caught the low, and we were still within that 13 count. So we were above the risk level of 13 count, which came in at, what is that, 98.77. So at the time, I think within a week, certainly 2 weeks of the low this year, I was bullish the dollar. So we've been right for, I don't know, 7, 8 weeks already. 105.97 target, we're getting close. You can see the horizontal purple line is potentially prior highs and resistance. The cloud now is here, and I've made the box of the cloud to include where it would be this week and next week to finish out a 9 count. So we might, even if we got above 105.97, I'm not convinced that we're going to surge from there. In fact, I'd probably take some trading profits. And there's nothing wrong with taking some already if you've been long. But this is the basic pattern. And the 9 count on the high, the 13 count on the low, and a potential 9 count over the next 2 weeks is coming. Bitcoin. So again, I don't typically pay a lot of attention to this, but I know a lot of you guys do, so I try to include it in our weekly piece, the uptrend line from last year's low. So this bottomed in, looks like the last week in October or so, 2 weeks after the stock market bottomed. It peaked in, when is that, July, the same time stocks peaked. So this has moved pretty much in line with stocks, pulled back. We're still kind of, look, the trend line officially has broken, but we're still right near it. Tough to say. The lows, also the low 2 weeks ago and, I don't know, maybe 10, 12 weeks ago are pretty much the same place that were prior highs, going back to August of last year and then February of this year. So kind of where this horizontal blue line is, we broke out from, pulled back to it, made a higher high, pulled back to it again. Tough call in here, slightly bullish, but nothing special. And last week's high even is the conversion line, the pink line. So nothing really. I don't mind being slightly long given this rounded bottom. But look, you're also potentially making a head and shoulders top, of which we've got the left shoulder and the head, and one more rally and pull back into this $25,000 range, and then you have your main inflection point. For the time being, nothing really to do. GLD, the ETF for gold. You can see I've been neutral gold, 1, 2, 3, multiple weeks in a row, nowhere. We got the downtrend line that we just closed a hair above last week, but the conversion line rejected price action. We went through it and closed beneath it. You've got still a partial unfilled gap underneath. The only thing that I could say that's probably a safer place to do anything is if the opportunity came and we got price action anytime in the next month and a half down into this zone, which is pretty much where the lagging line would find support from the top of its cloud to where the bottom of the cloud is now. So somewhere in here, and there is a TDST line, this dotted red line at 168.51, potential support. Otherwise, I don't see much to do in gold yet. If the stock market falls apart, maybe gold gets a rally. But right now, not clear. USO is the ETF for crude oil. This chart is quite different than the crude oil chart. In fact, I will tell you, if I were going to trade, if you were considering trading USO, I wouldn't. I would simply trade the futures, and if you're afraid of futures markets because they're very leveraged, the Chicago Merc is a step ahead of you by having created micro-sized contracts for many of the popularly traded commodity futures. So gold, instead of it being a change of $100 per one contract for $1 movement in gold, you can now trade gold where a $1 movement in the price of gold is only $10 of value in your account. For crude oil, it used to be a $1 move for the full big oil contract, which is 1,000 barrels of oil. A $1 move is $100. Wait, did I get that right? 10 yeah. Wait, no. A $1 move would be $1,000. Now a $1 move is only $100. So these micro-sized contracts are meant for retail traders, but it's still the cleanest way to trade these markets that are commodity-based markets. You're much better off trading the small-sized futures contracts than you are trading ETFs of them. So would I choose to trade crude oil futures, the micros, as compared to USO? Absolutely. Would I trade natural gas futures, again, micro contracts, compared to try to trade UNG? Absolutely. Would I trade COMEX gold micro futures instead of GLD? Absolutely. Now, GLD is the most liquid of the three I just mentioned, of USO, UNG, and GLD. The gold one's the most liquid. However, you're limited to them only being open during regular trading hours. And whereas futures are open 23 out of 24 hours a day, they are only closed from 5 p.m. until 6 p.m. Eastern time each day. 1 hour for the back office and stuff to make sure everything gets settled correctly. Otherwise, futures are open all day long. Much better to play them as far as I'm concerned. And I think going forward, maybe I will even switch and stop looking at like GLD and USO and UNG, which is over here. And instead of looking at those, let's just look at the futures contracts because cleanest way to play. So USO broke out of these prior highs. Crude oil did not. You can see that on the weekly chart, it made a higher high than the prior week, but closed beneath the prior week's close. So possible near term, getting tired. We're only on a 10 count towards a 13. So we still, for a few more weeks, still could, play in this range. 83.80 in USO terms is equal legs up. So if I take the lowest low back from April, or maybe even March, looks like March, I take that rally here, and I take that same distance off of the low that we made subsequent to that over here in April. It measured here, which was the high for almost a month. It then broke through. So now 83.80 is 1.618 times. So if we take that range, that first move up off the low, and take from the next low 162% of that move, that measures to 83.80. And that may end up being a pretty decent target for this, barring oil going to the moon. Now, notice how many people are talking about oil going to the moon at the same time that there are some stock market forecasts now for the market to absolutely fall apart, and that's not going to happen unless the economy falls apart. And therefore, if that happens, how is oil going to go to and stay above $100 in some of the crazy targets that super bulls in the oil market are talking about? So could oil still move up? Yes. If the S&P goes from 4,300 and falls to under 4,000, is oil likely going to be at $100 a barrel? I would say no. So put that in the context of things, which is something that we've talked about before when we look at the XOP, the oil and gas ETF, which for the last month I've been saying not a bad idea to lighten up and take some profits. Now, taking profits, when I say that, doesn't mean you're out of 100% of what you might be long, but it means you take some profits. And as much as it didn't look like it was the right thing to do, take a look at what's happened over the last 2 weeks, especially last week, and this is sold off. So any sales that you would have made are good sales relative to where this closed on Friday. Just beneath the closing price is the bearish propulsion momentum level. So like the S&P, like the Qs, they're very close to where those levels would kick in. They all came in. They're all disqualified because last week's close was a down close. So any penetration this week doesn't mean we can't keep going lower, but you're not going to get that official signal. You're not going to get these hyphenated lines turn into triangles, which tell me the rules have been met for these to actually be formal signals. Nonetheless, any sales you put on in the last month have actually now worked out. UNG, complete sideways nonsense. It's actually almost, 6 months already that this is just pure trading range noise, nothing much at all to do. UNG on the weekly chart is, and this is a very also different looking chart. In fact, let me see if I can, just to show you. So we've got the bunch of 13s, and you have that in natural gas also. But notice that last week we closed beneath both the conversion line and the baseline. And we've done that for a few weeks already. If I pull up a natural gas chart, notice that for the last 3 weeks, we are actually in between the conversion line and the baseline. So UNG, the ETF, does not specifically or accurately necessarily track natural gas in the same way. That's why if you're going to trade any of these, I'd much rather you trade the commodity itself. Learn, trading commodities or futures markets, it's a different animal. These are leveraged, but because of the micro contracts, you can, I think, trade far more comfortably with far less money to risk trading the micro contracts, which are liquid enough and can get you exposure into these with, I will say, more accurate charts, because this is what the industry is looking at. The industry is not looking at UNG to say, oh, what's the price of natural gas doing? They're looking at natural gas futures. They're not looking at USO to see what crude oil is doing. They're pulling up charts of crude oil futures and looking at it. And they're not pulling up GLD to look at, people in the industry are not pulling up GLD, a chart of GLD. They're looking at the price of gold, actual gold, not an ETF that tries to mimic the price of gold. So I think that's probably about as clear as I can be on that subject for you. So that's UNG on the weekly. Transports, the last chart we take a look at, these have broken down under both the bearish propulsion level, still not qualified, and what should have been some support in here. We got only a 1 week bounce, and then the last couple of weeks selling off. We're back down to a bullish propulsion level that never, despite the huge move up, never actually turned into the signal. In other words, it's still a hyphenated line, and it never did reach that 275 propulsion exhaustion level. It's the 9 count that stopped. Now we're getting close to this orange box level, which is the uptrend lines from, it's a major low from a long time ago, an interim low from last October's low, and the 50-week moving average and the 200-week moving average are all in here with a TDSD line and the bearish propulsion exhaustion level. Tough call what to do with these things. I kind of still watch what the S&P does and whether 4275-ish ends up holding or not. The relative rotation graph continues to show that energy is by far the best performing sector. The prior leaders of communication services, consumer discretionary, and tech have all gotten well lower into the weakening category. XOK is fairly horizontal at this point, pointing towards that it could end up going into lagging. Financials, which I upgraded a week ago Monday, look like they're likely to cross over and become a leading category. But here's the interesting one. Look what industrials have done over the last 3 or 4 weeks. They've looked headed for leading and have just taken a nosedive. So they look like they are heading back into being a lagging category. And if industrials go into the lagging category, then certainly IYT, what we just looked at, transports are part of industrials. That chart's not going to improve. Those are the two that are the most things that are outstanding on the chart. Is industrials doing what they're doing and financials looking like they're heading that way. Consumer staples, because of the bearish move in the market, have actually crossed from lagging into improving. So none of the charts now, none of the 11 sectors are actually both underperforming with increased downside momentum. Anything here left of the y-axis is still underperforming, but has improving momentum, or better said, is less downside momentum. So decreased negative momentum. So that's that chart. What do we have next? The week ahead, here's what Seeking Alpha tells us about the upcoming week. You read that on your own. We do have earnings reports every day next week of significance. And then as far as the important economic releases, nothing till Wednesday, but Wednesday, Thursday, Friday all have potentially market-moving type of economic releases. As I do the daily tip sheets each day, I go into a deeper look into other reports that come out each day, not just the ones that this website deems as being super important, but everything that comes out. So I give you that. Updated trading levels are here now. And here's a new trade idea that I've come up with. And it's a pair trade. And here's the chart. So this is a pair trade of long utilities, short real estate. Right, these are part of the 11 macro sectors to the S&P 500, and since September 1st, utilities have way outperformed REITs. Now, the last couple of days they shot up. So what I want to do is be a buyer on a pullback kind of to where this blue line is, which also is the midpoint of the channel. My target is up here into October. Potentially it could extend into November. I don't know, but I think we can we can target up here. And oh, that's funny. I thought I had a different annotated chart here, but the stop out I have here, where is it? Stop is beneath 1.758, which, if I remember, is I think it's probably this little peak in here. So if we broke underneath that peak, we get out. So we're going to buy some on a pullback. We're going to buy more down at the bearish propulsion level if it gets there, right in here, and then we'll stop everything out down here. But that lines up to be almost I'd say it's probably about a 3-to-1 reward to what we're going to risk on this. Open positions. I'm canceling the Sempra Energy trade because it already got to, or very close, I think within $0.50 of what my downside target was. So no reason to keep waiting for a bounce there. It's too close to the target. I'll still say if GE Healthcare comes close to where we got in, we'll take we'll break even or take a small loss. We can get right back in if it gets above 66 and change, but right now, let's see, where's GE Healthcare? So it closed at 64.33 on Friday. We're long at an average price of 65.62, so we're down about $1.30 on the trade. If we get close to it, I don't know. I'll look to scratch it. ENPH got hit on Friday, so we're down 1.88% on that. Amgen, so we bought no, we didn't buy. We sold a call spread on Friday. It got back to, we actually were able to sell it virtually on the high of the day, based upon what I had put in. So we sold it at about, where is it, 315. It closed at 227, so we're up about a little over 25% on that option trade just in a single day. And that, options trading is a totally different, that should almost be a separate account. It can still be within your trading account, but don't P&L how you do in options the way you P&L how you do in other trades. Notice that, in one day you're already up 26%, almost 27%. Options move very differently, super leveraged instruments, and that's that. So that is the webinar for this week. Again, I am off on Monday for Yom Kippur, so that's why I'm giving this to you now, so you can watch it anytime, today, Sunday, later today, or Monday morning, whenever you want. I'll send you, as soon as the software gives me the link to this webinar that I've just recorded,